Hello, this is Dale. We just got out of a very profitable trade on the RUT yesterday. Wanted to go over that trade with you, show you how profitable these credit spreads are. This was a monthly trade on the RUT, and it was a bear call. The beginning of April, I put out a YouTube video talking about the probability that the market was going to be a little weak. And reason I said that is I was looking at the chart, and of course my three indicators are the regression channel, the plus or minus 1, plus or minus 2 standard deviations of that. 95% of all prices are contained within this plus or minus 2, and you can see that it was up between the plus 1 and plus 2. After it made a measured move, it had moved to the 127 on the Fibonacci between the 127 and the 161. And right around this time period, I put out a YouTube video saying I saw weakness in the market. And indeed, that's exactly what happened here. So during this period, this was a good time to put on bear calls. Credit spreads to the downside. What we're doing with bear calls is we are selling a call and then buying one further out of the money. I'd like to go over this slide because it's very important and major reason why I specialize in vertical credit spreads. I did a YouTube video on credit spreads versus debit spreads. They're similar, but the beauty of credit spreads is we are the sellers of premium, and therefore the time is in our favor because when we sell an out of the money option, the only value it has is the time value. And the longer you're in that trade, that time erodes, and that premium is what goes into your pocket. So you get great returns, and I couple that with a high probability trade. I just recently did a YouTube on how I select my strike prices to give me the high probability trade. Trading vertical credit spreads yields monthly income on a consistent basis. I'd mentioned that we are sellers. We're sellers of premium. Time is money. Another nice thing about credit spreads is you don't have to constantly watch the market. I watch the market when it opens in the morning, usually check in around noontime and watch it during the close, and that's about it. With credit spreads, you're not going to get that big of a move, and if you check in about 3 times a day, even less if you want to, you're not going to be hurt because if you're studying what the position is, you pretty much know when the market is moving, what to do with it. These are low anxiety trades. You're not going to get whipsawed so much. And of course, we have protection against loss because we're always buying an option further out of the money for protection. We're not doing naked sales. Of course, this is the chart showing the rapid decay of time, especially during that last 30 days. And this is to our advantage because we are the sellers. We are taking that money in. Again, this was a bear call. Bear call is a type of option strategy used when you think the price is going to be declining. The beauty of the credit spread is if the price declines with a bear call, you can make money. If the price stays the same, you can make money. If the price goes against you a slight bit, you can make money. And what you're doing is you're selling one with a specific strike price and then buying one further out of the money. So here's the chart for our bear call spread on the RUT monthly. You can see that the RUT had been coming down just like the rest of the market. It came down to this point right here, and this is what's called a measured move. A measured move in this case is a lower high and a lower low. This is a classic definition of a downtrend. When I saw this happening, this is when I got in and I sold the bear call by selling the 17 June. We went out about a month, a little bit more than a month, the 196 call, and then bought the 197 for protection. Now, a lot of people say, well, why didn't you just sell it and take all that credit in rather than buying one back and having a net credit of $2? This would be selling naked. And it's interesting because the margin required to do that, first of all, you have to be at the highest level of trading with your broker. And they're going to require a large amount of margin for you to do that. When you trade a credit spread, you can put on this protection and you're getting about the same return on margin you would as if you were selling naked. It was only 1, 2, 3, 4 days later that we bought this bear call back by buying the 17 June 196 and selling the 17 June 170 for a net debit of 65 cents. I never let these trades go to expiration. We had this till 17 June, and we got out a lot earlier than that. We got out right around, this was right around, like 4 days later. So it was the beginning of May. So you look at the profit potential for this. We sold for $2. We got that, and then we bought it back for 65 cents. That's a $1.35 profit, or $135 on one contract. One contract is going to require there will be 100 shares in a contract, and we went with a 10-point spread here from 1960 to 1970. So it's 10 times 100, or $1,000 required per contract. And you're making $135 on that $1,000 investment. For 10 contracts, you're bringing in $1,350. And for 50 contracts, yes, indeed, there are people that do that. You're bringing in $6,750 on 4 days of trading. I have to mention that the past performance is no guarantee of future results. But we consistently are winners. I release trade alerts when I see a trade that I'm going to make. This was a trade that I released, and I want to show you how I do that. We send out text or email alerts. This is the text coming out on 5/9, and this was Monday at 10:20, and we show that we want to go ahead and enter a bear call for a credit of about $2. I had this date wrong here. Yeah, I'm sorry. I put in the same order here rather than putting in the sell order. But in any event, this is the text alerts that I send out. We also send out email alerts so that people can either get one or the other or both to get their trades. This is just an example of the risk profile. The risk profile I use to manage the trades. This green line is what it would be worth at expiration. The purple line is what it's worth today. This is the break-even point. And usually what I do is I put in a line right here, which is 6% of margin. I don't want to lose much more than that. And this is about 10% of margin. Once I've gained that, I want to take my profits because, I got that in 4 days. Why wait around another month and a half to catch a little bit more? This is actually where it was today. So we were above our goal here when we took this profit. This is our equity curve for all the way back to 2019. I've been publicly releasing these alerts for the last 11 years, and I just wanted to show you the last 2.5 years to show you that this continues to have a positive expectation. Yeah, we do have losers. We have losing streaks. However, we have a positive equity curve, and that's what you're looking for in trading. Now, I'd love you to become a member. All you have to do is go to www.optionsinfinity.com. The price per month is less than what you would have received for one contract on the RUT that I just showed you. Currently, I have a special on. This is that my strategy is relatively simple. I like to keep things simple. That but it's hard to master. And I want you to take the time, watch me, watch how I trade, make money while you're learning. And therefore, right now, I'm offering, if you're a member for 3 months, I'll give you the 4th month free. I've been doing this for a while. I am going to be taking this added subscription bonus out the end of June. And this currently we're in May of 2022. So by the end of June 2022, this no longer will be a special. I hope you and all my serious people want to learn how to trade credit spreads, learn how to be a consistent winner. Please contact me on www.optionsinfinity.com. I look forward to teaching you and having you make some money and attack this very difficult market. Hope you enjoyed this video. Bye-bye now.